Hey, good morning, everyone. Marty Missouri here, Monday, 22nd of November, 2021. In this weekend's macro update, I suggested that there's just a mountain, so to speak, of information, market-related stuff that's worth sharing here on the blog. And I said that I'd probably come to you early in the week and begin a series of videos and just try to be succinct and give you a dose at a time of what we're seeing. This will be good information as we head into 2022 and as I begin drafting our what tends to be a pretty lengthy year-end letter. So for this morning, I want to kind of pick up where I left off on the morning note and touch on that notion that the stock market and the bond market more or less disagree about the future in terms of what is soon to happen with regard to the Fed funds rate. The bond market this morning reacted aggressively to the announcement that Jerome Powell looks to be keeping his job. The two-year yield, which is considered a harbinger of where the Fed funds rate is going, jumped a big 10, 11%. Longer-term rates rose as well. The 10-year was up like 3.5% in terms of the yield. However, that's still a flattening, meaning the yield curve, the short-term rates rose faster than the longer-term rates. And a flattening yield curve actually is an indicator of weakening economic activity going forward. So I suspect we'll be spending more time on that phenomenon as we go forward. But again, with regard to the morning note, I suggested that if the bond market has it right, and the Fed is going to get more aggressive going forward, then the stock market has it wrong by rallying on Fed Chair Powell's renomination. Well, since I wrote that this morning, the stock market maybe is beginning to agree a little bit with the bond market. The chart that you have here in front of you is the NASDAQ Composite Index, which was up like 1% early on this morning. See the big move. But you can see what it's done since. It has absolutely rolled over in a big way. Now, remember that the NASDAQ is where big tech and big discretionary names trade, and those are big in terms of concentration in the S&P 500 index, for example. We have the kind of concentration in a few names that we haven't seen since, right at the very peak of the tech bubble. So absolutely something to pay attention to. And as I've been pointing out of late, the breadth reading on that NASDAQ comp really has my attention. See, and this is a chart, and we go further back, but I just for illustration purposes, you can see that when breadth is rolling over, it really denotes an unhealthy market. Essentially, just a few boats are rising with the tide. And it can precede some pretty weak periods. This was a 23% decline in the NASDAQ composite. And of course, this was a 32% decline, even bigger for other indices. And you can see even pre-COVID, the NASDAQ breadth was rolling over. This rolling over here preceded a 13% decline. You had some weakness in here as it was rolling over. And as you can see here, folks, this is a big rolling over of the NASDAQ composite breadth, while the index continues to move into all-time high territory. Rising interest rates against stocks that are considered very long duration in terms of what they're discounting, that makes for a great deal of interest rate sensitivity. So when I saw the NASDAQ up 1% this morning and saw interest rates up as well, I had to wonder if that's going to hold. And, it may. This is a very choppy market, and it's a holiday week, so we could have lower volume than normal. So indeed, we may see the NASDAQ come right back out of this, and you can see it's trying to rally a little bit right here. But make no mistake, folks, a higher interest rate regime and certainly a higher dollar, which we'll get into more going forward, is a huge headwind against NASDAQ stocks and against really assets in general. So the fact that, as I keep saying, it looks like everybody is still trading the old bull market, I think the setup going forward is going to be vastly different than the setup we experienced since that bottom in 2009. And here's a look at even the S&P 500. It's still slightly up. Actually, it's up about 1/3%. It flirted with the flat line here just a little bit ago. So it's also, though, way off of that high. It was up about 1% this morning as well. The Dow is still up 220 points. I think it was up 300 at one point this morning. High interest rates are going to be really sweet to the bank stocks. Remember, banks borrow short and lend long, so even though short-term rates are rising a bit, the market is going to buy the banks when interest rates spike, and that's what's happening this morning. So Goldman Sachs, for example, is dominant in the Dow, and as is J.P. Morgan. So those two having a nice rally this morning, it really explains a lot of what we're seeing in the Dow. And then beyond that, I also mentioned that setups are beginning to emerge that look pretty compelling, and I'll just touch on that just for a second. I'll start with this chart of the S&P 500 versus asset classes and regions that are now pretty prominent in our core index. So this chart right here takes us back to the beginning of it takes us back to the bottom of the tech bubble and through the top of the real estate bubble. And this is emerging markets, this is Asia Pacific, this is Europe, this is gold, this is the US, and this is ag commodities. So this was the relative return setup of the bull market as it was peaking. So as the previous bull market was peaking, and I'll just go back to 1990 and we'll move this one up to 1999, you'll see that US stocks, once it loads, US stocks led the way in the previous bull market. And by the way, this is normalized for percentages, right? So for that stretch, US stocks were up 300%. Europe had a great go of it as well, and particularly toward the end of it. It came close. But then we had emerging markets, Asia Pacific, ag, and gold really lagging these two. Okay, so again, this led to the setup I just showed you, right, where it was the next bull market saw US stocks as gross underperformers, right, after being big outperformers, okay? And then here we are today, bottomed in March of 2009, and that has just an absolute canyon of relative outperformance for the US. So what would you expect where you had this huge outperformance? Do you really expect that we're not going to get some reversion back to some long-term normalcy, which would be, US stocks coming down, these coming up, or meeting somewhere in the middle? I suspect that's a high probability outcome, particularly as we look at things like the commodity space. And we know we are, this big conversion to renewable energies, right? Well, the commodity producers, right, have not been investing in expansion like you might expect. In fact, we're still down 34% on a year-over-year basis. That's a negative. Should be a negative right there when it comes to capex. So, having what they experienced after that huge bear market from 2011 on, the commodities producer space is not, aggressively, at least at this point, I suspect they will at some point, expanding capacity to meet, this new higher price regime that we just virtually have to have going forward. Gold and silver miners, this is the work of Crescat Capital. They're very bullish on metals, are exhibiting free cash flow that is just absolutely historically good relative to their own history and relative to the other sectors out there currently. And here's a chart on gold. Gold peaked back here in around 2010, 2011, and they're kind of peaking again. This looks kind of like your long-term cup and handle formation, which is pretty bullish. And I think if we're right on the fact that the Fed is going to have to go easy amid rising inflation, which leads to lower real yields, that's a nice setup for gold going forward. So we think that makes sense. And then lastly, when we're talking about metals, when we're talking about this big shift to renewable and the huge pressure that's going to put on the metals and mineral space, then we need to be thinking about the areas of the world where we're going to have to go get this stuff, and then how those opportunities look, again, on kind of a recent history basis. And here's our tracking of select Latin American markets. This is year-to-date Argentina, Brazil, Chile, Colombia, Mexico, and Peru. Chile houses the world's largest copper mining facilities, right? Brazil is very big in iron ore. Lithium is big in Latin America as well. So folks, when we look at US stocks, right, which are just virtually off the charts, certainly on a relative basis, and then we look at other parts of the world that are uniquely positioned to take advantage of where we know things are going forward. Well, yeah, they really have to like this setup going forward off of these levels for sure. And then lastly, just take a look at how that looks. And I'll just show you the daily chart and then let you go. So this is ILF, which is our Latin American ETF that we hold as a core position. So you can see it's had a rough go of it here of late. It's beginning to look like it's carving out a downward sloping wedge. And you know how bullish that pattern can be from previous videos. And we have what would be, you know, these would be positive divergences. They're pretty flat, and if this looks like it's about to turn up like it's suggesting here, you know, at least on the daily chart, we may be on the verge of something noticeable in Latin America going forward, which is what we expect on a long-term trend basis going forward. Ironically, ILF is up a little more than 1.5% this morning. And by the way, just since I'm on it, and then I'll close, metals miners are up 2 2/3%. And I mentioned banks, those are up there. Energy, interestingly, energy stocks are up 2%. That is interesting because we know that world governments are trying to coordinate a release of strategic petroleum reserves, and all they can hope for, I think, is a short-term number on the price. That's interesting that oil is bouncing this morning. And then, but what's really getting hit though, gold, as I mentioned, and gold's coming off of a pretty strong rally. I think I mentioned that already. And so we're pretty split down the middle. Our core index, I think, is just barely flat now. We were up a bit at the beginning of the day, but yeah, right now it's up 7 basis points, 0.07%. Small caps were up 1%. Small caps are flat right now, up 0.04%. The NASDAQ was up 1%. The NASDAQ is currently down 1/3%. The NASDAQ 100 is down as well. The S&P is trying to bounce its way back up. So folks, we have overall, when you look at sector by sector and then the internal, certainly for the NASDAQ, we have really ugly breadth right here. And I'm not saying that it means the market's about to roll over, but it's certainly a warning signal that we need to respect and pay attention to. I'm very glad that we're hedging with options against the potential for big downside. And I think next year is going to bring us quite the volatility. But make no mistake, folks, the setup, the underlying fundamental setup is very, very different than what the current bull market, and I'll say that kind of skipping last year's big decline that really happened from a time standpoint in the blink of an eye, right? It was a 3-week decline. So folks, whether you want to call this, you know, a new bull market after last year's very brief bear market or a continuation of the old bull market, I kind of favor the latter, but I can tell you this. Certainly it's the latter that the consensus seems to continue to trade. And I can tell you this, that is not the underlying setup as I talk at you today. I'm actually optimistic about a lot of what we're doing going forward into 2022 and beyond, but I do think there's an unusual amount of risk hiding under the surface that we need to be very cognizant of. I'll stop there. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.